Okay, good afternoon and welcome to the Reuters Wealth Newsmaker with Philipp Rickenbacher, CEO of Julius Baer Group. So Philipp, thank you so much for joining us today. My name is Lisa Jucca. I'm a financial columnist with Reuters Breakingviews, and apart from Philipp, I'm also joined by Rob Cox, who's the global editor of Reuters Breakingviews. So we are going to spend the next few minutes trying to figure out a little bit what lays ahead for the wealth management industry, but also for markets and investors, given the few uncertainties that we're now facing. And obviously, this is a great opportunity to speak to one of the leaders of the biggest pure play private bank, so an opportunity to really get an insight. Before we start our conversation, I also wanted to mention to the audience that you will have the opportunity to interact during this conversation. We will be asking you questions through a polling system, and you will also be able to ask questions through a Q&A chat that you should see in front of you. So feel free throughout this conversation to ask questions that we may then put to Philipp. But without further ado, I'd love to kickstart this event, this live event, and I'm just turning to you, Rob, to kick it off.
Okay, well, actually, I was supposed to give the introduction, and Lisa, you stepped up, and I am so proud of you and so happy you did that. I'm sorry, guys, for that. So I'll kick off with a question, a simple one. Philipp, the world seems to be coming back. So you go around and you see queues in front of places like the Starbucks in Milan. That makes no sense. Or the Uniqlo in London. It seems to me like everything is booming again. And I'm not so sure. I'm just curious to what extent you are, when you look around the world and you're trying to safeguard the assets of the wealthy, to what extent we should be worried? Like, what are the things that I hate to be like the pessimist here, but what is it that kind of keeps you up at night at the moment?
Thank you very much, Rob. And Lisa, thanks very much for having me today. Great pleasure. Even though I think Lisa promised me kind of a fireside chat. I think that's the virtual version of the fireside somewhere between us. But I still hope that it's going to be an interesting discussion among us. So what keeps me up, or how do I look at the people queuing out there in front of Starbucks? I think we still live in extraordinary times. And the pandemic is not over yet. I think obviously we see some countries that have declared the end of it. They might be right. We'll see whether or not. I believe we'll see non-linear rates of recovery across the globe, and some countries will take longer than others. We're still in a bit of a supply side shock. And I mean, when I look at listening to clients who are in shipping who say it takes 5 days to get a pilot to get a boat into harbor, we still have challenges there. There's still a lot of demand driven by actually government subsidies and state aid and support. And so I think this is still quite an extraordinary phase. Yet I do believe in human resilience, we will find our way through this. And at some point, we will be looking back and say the pandemic has ended at some point. But until then, we still need to chart ourselves. Doesn't keep me up too much at night. I think we've learned altogether to live with this market situation in the last 1.5 years. We're trying to make most of it. We're trying to be close to our clients. We have as many conversations as we had last year. And those are many more conversations than we had in any previous year. And so this is a very busy time for us, and it's going to stay like that for a while.
I guess the sort of question is, we saw the last week or 2 weeks a bit of wobbles in the markets, right? Global equity markets. But you look at the valuations, and they're still kind of off the charts, right? And I always think of, when I think of Julius Baer and I think about what you guys do, is ultimately also about protecting wealth, like the wealth that's been built by families or generations or new entrepreneurs. What is the sort of, how do you've been in this for a little while now. You've been CEO, I guess, for 2 years just about now, but you've been in this business. How do you talk to clients about the risk of just the simple risk of like overvaluation in the marketplace?
I think there are two things. I mean, one is, are the valuations justified? And the other element is good risk management at the client level altogether, which I think clients should be doing regardless of the valuation of assets, which they also have to do on the other end of the spectrum, for example, when holding excessive cash positions that are sure to lose value. That's the only thing that is really assured out there in the market. With respect to the valuations, I mean, obviously we have no crystal ball, as no one has, but in our humble professional opinion, we're not at a point where we are hugely overvalued. I think the equity risk premium are there, it's intact. Obviously, yes, there is pockets of overheating, but I don't think that structurally we're at a point where we should have sleepless nights. On the other side, yes, there is obviously a lot of potential for things to happen at the level of those valuations in the current geopolitical environment, given all the events and the news flows out there. So good risk management is absolutely key. How do you achieve this? You achieve this by properly balancing your portfolio, by focusing on your asset allocation. That's what clients should always have done and should always do into the future, by having a proper view on the liquidity profile of a portfolio and not keeping everything in liquid, but obviously also not ending up in an illiquidity trap. And that's actually the work that we're doing with them. So I think those clients who have been in a robust asset allocation actually throughout the last 2 years, and there have been quite some market shocks, for example, at the beginning of last year's, those clients that stick to this strategy have fared extremely well. And there's no reason why this tried and tested approach should not work in the future.
Yes, I mean, Philipp, if I may step in, obviously you spoke about clients and being close to clients and, you know, the choppiness we saw last year. But this choppiness has also been beneficial for Julius Baer. I mean, you had a great year. I mean, trading activities certainly helped your bank. So the question now is, do you still see activity continuing or restarting, if you want, at a healthy level? And I'm talking about activity from clients. Or if not, where is the engine, the next, if you want, engine of growth for Julius Baer?
Those are many questions in one. I think if I look at the last 18 months, yes, of course, the surrounding conditions have been very strong for the wealth management industry as a whole and for Julius Baer. And I mean, we always look at things like the average daily trading volume or the prevailing market volatilities as a proxy for client activity. It's a pretty good proxy. Obviously, this is not at the same level right now as it was at the beginning of last year, but still, if you compare this to those years of inertia and inactivity that were preceding 2020, I think we're still in fundamentally different market conditions, and I don't think that this has to change in the short term. I mean, obviously, and one always needs to be mindful of that, then the tide is lifting all the boats. I think it's also leaving in the entire industry to the fact that everyone wants to be in this, that everyone will hold on to wealth management for the time being, even though not everyone out there is doing it at the same level and under the same economic conditions. But we might be talking about that a bit later on. But what's next? I think the world is always living in cycles, isn't it? And I think we've seen boom and bust cycles. We've seen cycles of trading activity. We have seen cycles of relative calm. And I think the magic in our discipline is to be set up for all weather, is to be capable of capitalizing on trading flow, but is also to be able to go through the desert when nothing is happening. And the key to this is diversification of the solution range, is mandates, is asset-based revenue sources, is a strongly diversified revenue base, and an ever-increasing range of services in concentric circles around that core of investing and financing, which has always been the center of wealth management. And I think we've done that pretty well over the last few years. So I do believe we need to prepare for all kinds of future, and that's what we do every day.
Yes, Philipp, I mean, you've been a bit modest when you say, you know, the entire wealth management industry has been lifted. Yes, I mean, this is for sure, but, you know, Julius Baer shares outperformed their immediate rivals. I mean, your bank has outperformed the Swiss stock market index by quite a large level. And you're also ahead of most of your targets. So, you know, there's a lot of work that has already been done in these 2 years. So, you know, I'm really trying to understand what is your next strategic focus. I mean, will you, for instance, expand, you know, into a slightly different pool of clients? We've seen rival bank going for slightly less wealthy clients. You know, I don't need to mention those, but I think you know who I'm talking about. But developing apps, you know, to engage with slightly more affluent clientele. I mean, is this a focus? Is this potentially an area of growth for Julius Baer?
It's a very interesting question. I think if you look at this strategically, we've been very clear at the end 2019, beginning 2020, when my time as a CEO started, that we fundamentally believe that the conditions in which wealth management is happening today and happening tomorrow will not look the same as they did in the last 10 years. And I think that the pandemic, the last 1.5 years, have actually accentuated that. Even though, as I said, some of the market conditions may keep some boats afloat, I do think that the fundamental forces at work, which are the margin pressure out there, the commoditization of businesses, but also the needs of clients, which are rapidly changing. And I'm talking about the elder generation and not about the young generation, which is going to accelerate this even more. The need to actually constantly enhance your solution range to stay relevant for clients, because otherwise, wealth managers will be replaced with other offerings out there in the market, with new attackers, with new verticals and slivers. I think this is all happening out there. So this is a highly challenging field. And I think it's very, very important to have a very clear strategy, but also to have the firepower to execute it. We have demonstrated in the last 1.5 years that we had a very clear strategy. We've executed on it on a very high pace. Maybe to some extent even helped by the pandemic and the fact that we were all very focused on strategic execution. And so we've created, I think, a very sound all-weather platform that allows us now to attack the future. Where will that future go? I think at the core for Julius Baer, we are a leading wealth manager, and we are a very focused wealth manager, just focusing our activities on the needs of ultra high net worth and of high net worth private clients. I think that kind of focus has served us extremely well and is going to serve us well for the future. So I wouldn't want to stray too far from that. But maybe tomorrow's client definitions will go a bit away from wallet bands, and it will not matter that much how much liquid assets a client has, but more what the needs of him or her are, and what's ultimately also the ability and the propensity of the client to pay for proper services. And so we might be seeing slightly different definitions. But then more things will happen on the solution side. I mean, let's take wealth planning that has been a key discipline in the last 10 years. Let's take advances on the financing side, which are critical. These things need to be developed and services around. Let's take tech. We could talk probably an hour about what technology might be doing to still humanly dominate the business. We will be talking probably about ESG and what's happening next there. We can talk about crypto. So you need to be on top of those developments. And I think this gives us plenty to go in moving the business. And then obviously also the geographic footprint, I think, where we're set up extremely well, but which we obviously continue to monitor moving forward. So I think we have a very clear strategic view on how we can further evolve Julius Baer from a position of strength and continue, in a sense, to reinvent wealth management for that next generation in the next years.
Okay, no, that's interesting, of course. I mean, you mentioned tech, which I know is a subject that is close to your heart. I mean, without, let's say, having too long of a discussion, I'm however trying to, you know, I'm interested in understanding what is the right fintech model for Julius Baer. There's a lot of talk about robo-advisory or hybrid advisory or just, you know, the apps for a certain type of clientele. What is the right model, you know, for your bank and the model that you envisaged for your bank, you know, in the realm of fintech?
technology is transforming our business very fast. And in a sense, the pandemic has been an accelerator of that. As you know, we've introduced a number of additional client touchpoints during this time, be it the WhatsApp, WeChat channels, but be it full-fledged video identifications of clients and onboarding processes that don't require physical signatures anymore. So these are all things that would not have been conceivable in a private banking context 2 or 3 years ago. But these are just, I'd say, mere tools. And I think for us, the last mile to the client, the ultimate client interaction is something important, is something how the quality of our services is measured and where clients are looking for convenience, but it's not the only thing. And it's maybe not even the core thing of what we're all about. Julius Baer in wealth management is very much about human interaction, human advice, human support. Is about a personal contact of a client with a wealth manager. Obviously a personal contact that is heavily supported by technology. Also a setup where the human factor can be made scalable to some extent, as it is still one of the biggest cost factors in our industry. But also as we want to multiply our expertise in the best possible way. And this is really where we've been spending most on technology in the last maybe 10 years, and where we continue to spend heavily in enabling our relationship managers, our investment professionals to actually deliver the best possible service in a scalable manner. And so a lot of innovation is happening below the hood and is not outside visible, it's not blinking and it's not making noise, but it's just happening there, and it's ultimately through that adding value to clients. And then the third element in tech is always your basic technology.
Yeah, so technology supporting, but not replacing or fully replacing the relationship manager, right? I mean, is that more or less the vision?
That is a very simple but strong capsule, yes.
Okay, so you also mentioned earlier on one of the other challenges that the entire industry faces, i.e. the margin pressure, which has been there for a very long time and it's not going away. So is there a need basically for wealth managers to have a critical mass, and where is, I believe there is, but I think that the bar is getting higher. So I'm asking you, where is that minimum level nowadays? For wealth managers to be really competitive and not to be sort of pushed around by the big boys.
You're giving the answer with your question. I think, yes, indeed, there is a need for critical mass, and the waterline keeps rising. It's hard to express this in very specific terms. And I think assets is actually a pretty bad proxy, because the easy thing in today's market condition is just to grow your asset base in an unprofitable manner, but that's not going to help you do anything serving your clients better or creating a more robust organization. In the end, it's all about profitability. It's about your ability to generate capital that can be reinvested. It's about your ability to really attract the top talent across the globe that will help you further develop. And that's more driven through profitability than anything else. And maybe in the past, the way how critical mass was looked at was also very much from a global level. So you have to be a global wealth manager with 500 billion of assets, which we almost have today. But I think this also slightly misses the point that we're operating in a pretty fragmented industry with very deep national requirements, with very specific, not even just regional, but national requirements, be it in the regulatory sense, be it in tax terms, be it when it comes to client requirements and culture. And so I think the successful player of tomorrow will have achieved critical mass in those geographies where he chooses to play. And that is a slightly new game compared to before.
Okay, I get it. It's not just the global number per se, but how strong you are in certain jurisdictions. But again, if I look at Julius Baer, you are in a very favorable position at the moment. You have excess capital. Your stock price has been rising quite a bit. So you also have a strong equity currency. Do you see yourself as a consolidator in the wealth management industry?
No, we always have, but not for its own sake. And let's be very clear. I think we are in a growth industry at the end of the day, because wealth across the globe will continue to develop just with the growth of this planet. and in a capitalist model, in a good sense of that term. Wealth management will, in that sense, always be a growth industry, and we are well placed with a portfolio of countries, more mature markets, but also growth markets. So growth is something natural, I'd say, in wealth management, and for sure with Julius Baer. We want to look at the quality of this growth, and that's where it comes in. And how do we drive profitable growth moving forward? And you can do this in so many ways. You can do it by expanding your share of wallet with existing clients. Very straightforward source, not easy to do, but it works. You can expand your cohort of relationship managers, and you can do that by hiring or by building up your own talent in-house. And then M&A obviously is an important way of doing it. And we've done it a few times very successfully over the last decade. And I'd say 3, maybe 4 transformational deals have really brought us critical mass in many markets. There's no reason why this would not help us master the challenges of the next decade. The question is always the availability of those opportunities. I'd say in today's very strong wealth management market, no one's really a seller at this stage. But obviously we will be prepared, and we think that the difference between the good and the less good players will be more accentuated moving forward. We'll see how this plays out. But if opportunities arise in the right quality, the right price, we will be ready.
Maybe one last question before we engage the audience and broaden up the topic of our conversation. Yes, I mean, you've done a few acquisitions over the years. I mean, I'm not so sure whether I would define them as necessarily transformational, or at least some, I would define them as transformational, but, you know, would you engage in something transformational, you know, something very large, where maybe, you know, the other partners is also quite sizable and not just a bolt-on acquisition?
I think at the end of the day, the strength of our model has always been around our absolute focus on clients and our ability to really focus on each individual client. It has hinged around our independence and our ability to really focus on this business free from constraints, be it on the corporate banking, on the investment banking side. And I do believe we need to project those qualities very strongly into the future, no matter what we do. And if we have this in mind, and if we then think about how can we add value to our clients, then we will have the right lens for any potential, let's say, larger or smaller scale M&A activity moving forward. And again, the quality and the risk lens play a big role. I don't think that we need to preclude this. We need to box this in, but I have a very clear strategic objective that I would like to achieve through, for example, M&A. And that's the right way to take it. Okay.
Thanks for answering those questions. You know, as I said, I'd like to broaden the discussion by engaging the audience. We have a question to put to the audience, if I can see that question, and this concerns the current challenges for investors. So if you want to answer those, you simply have to select your preferred option. The question is, which of these will be the biggest investors' challenges in the biggest investor challenge in 2022? And we have a selection between a Chinese real estate collapse. I mean, we're obviously all aware of what's going on at Evergrande, for instance, rising inflation, the energy transition, now in focus with the upcoming COP26 talks in Glasgow, and the new global tax regime. So if you want to engage, and I strongly recommend you do, I mean, just please answer the question. We want to see your answers. I mean, it's going to be anonymous. We'll just see an aggregate, but it would be great if you can participate. So I'll give you a few moments to answer the questions. Again, which of these will be the biggest investor challenge in 2022? And we have a Chinese real estate collapse, rising inflation, the energy transition. Oh, okay, here we are. So let's see. So most of you think that rising inflation is a business challenge, right? Then the energy transition, and then let's say Chinese real estate collapse and new global tax regimes head to head. So, Philip, if I can bring you in, what do you think? I mean, would you agree with what the audience is suggesting? I mean, is rising inflation the biggest concern at the moment?
I think it always depends on which time horizon. Frankly, looking at how we look at the world, we might be a tad less worried about rising inflation. Obviously, again, this is very hard to project, and one needs to take a professionally calibrated opinion to this. I think, to the least, today's inflation situation, yes, the numbers will still be rising in the short term, absolutely. But will this truly be structural? I think in order to see that, one would have to see also the ebbing off of the supply and the demand side effects. And right now, I do feel that there's too much overlay of the different factors to make a very clear statement that this is already structural. And then there are a few other factors, like looking at credit growth. I don't think that this is spiraling up at a very fast speed at this stage either. And so there are a few things that by historic means, you would at least not have judged that a very structural change of inflation is just around the corner. But again, I mean, we might be wrong. And this is something that needs to be watched very closely, and where we'll probably have a degree of uncertainty for a certain period of time.
And
I do think that.
Okay.
Please
go ahead, please, Philip.
No. I think if I take all others.
Yes.
If I take all other elements that you set out as the biggest investor challenge, I find it interesting that it's actually only a very small percentage point being worried about the Chinese real estate collapse. I'm also not worried about the collapse. I don't think that this is the scenario, the key scenario we should be looking at. But obviously, I think there's a lot of non-linearity now around how the Chinese government is handling this specific crisis. So this is something that needs to be watched very, very closely as this plays out, and as it may also structurally affect some of the industries. And then, let's say, another topic like energy or taxation are more of long-term nature. They will keep us very busy in the years to come, but may not have that a short-term impact now in 2022.
Philip, is there something you would have put on that list that we're missing? I mean, is there a sort of risk that should be in there that's not in there?
I mean, more in general terms, I do think geopolitics play a big role today, and maybe a much bigger role than in the years before. And I mean, I see this at the big level. If you look at the big blocks of politics between the US, between China, Russia, Europe. If you look at the leadership transitions that are happening in some of those blocks and where they're heading, I do think that this is a world that is currently being rebuilt, and where things are happening that were not quite foreseeable a few months or years ago. If you just take the latest move on the French submarines and the building of a defense alliance, I mean, these things they have come maybe a bit out of corners from which they were not expected. And so that's clearly something I want to watch. And then the other element is, I think, on sustainability. I think we're all on our toes, and this is not just a matter for the financial industry. This is a matter for the global civilization as a whole, for politics, for all stakeholders, for the industrial players, and the financial system somewhere in the middle as a transmission mechanism. But we will have to find answers to the challenges of today in the next few years. And I think these answers will have to happen at completely different scales than they happened in the past. I'm much more confident coming out of this pandemic about the ability of mankind to respond. But if those responses are geared up and put to scale, then I do think this will change the investment landscape quite considerably.
Just sort of picking up on that, I mean, one of the questions that came in from the audience is, how does Julius Baer make sure that key staff really take corporate sustainability and business ethics to heart? Also, no propaganda, please, was the gentle suggestion from the audience.
No, and I think this is absolutely not about propaganda. This is about doing very concrete things, but also having a very sober view on what needs to be done. I think that the world is pretty clear what's the funding gap that we need to close moving forward, 5 to 7 trillion per annum over a number of years to make those investments into the future, into the technologies of the future, to allow a less carbon intensive world. And for this, all the different elements need to play together. As I said, this is a multi-stakeholder story. There needs to be political action. There needs to be legislative action. I do believe that, for example, CO2, carbon dioxide, carbon needs to be priced properly. As long as externalities are not fully priced, it is very difficult to create the market around it and to let market forces work. Then there needs to be a lot of innovation and a lot of drive on the industrial side to make these things happen. And probably we'll also talk about things like decarbonization technologies. We'll talk about fusion as a future source of energy because the conventional approaches might not be sufficient. And then there's the financial system in the middle, which will have to play. Yeah, but fusion, huh? Not just building conventional nuclear plants at scale. I don't think that is going to solve the problem either. And then you take the financial system, which is the transmission mechanism in the middle, and then we'll have to get much better together with all other players to create transparency for those who take decisions, be it when we take decisions on money on our own, but actually even more so when our clients take decisions, be it the institutional or the private clients, to have proper reporting, to have proper direction. Then we need to have even more choice and the way to deploy capital in a much more targeted way. I think all the efforts now happening in impact investing, and they're great, but they have to be scaled up much more, which is complex. And then we can contribute actually to education and to co-creation and to a dialogue with our clients who end up being among those people across the globe responsible for the economic development in different countries again through their firms and their investments. So finance system plays a role in that. I take a very sober view. We have 1,000 steps to make. We're in the first few, and all of us need to work together at a substantially higher pace to get there. Are you part of the GFANS thing that Mark Carney's doing? I mean, what role, where is Julius Baer on the climate change front? What are you doing as part of that? I mean, we have been early signatories on some of the protocols, the PRI, among the first banks to sign PRB. We obviously do very comprehensive sustainability reporting, and we show where we want to go. We are trying to decarbonize our own operations, even though that's a tiny bit of our footprint. Let's be very clear. I think banks are not companies emitting a lot of CO2 per se. I think the pandemic has helped us a lot resetting on travel. That may have been the biggest source of carbon coming from our business. And I do think we're going to be much more conscious moving forward. And then I do believe that our entire industry is moving towards a net zero. But I want to do this again in a way that we all know what we're subscribing to, and that we can also have more immediate impact. I don't quite like the marketing way of doing it and say, yeah, we can all be net zero by 2050, but it's next management who has to do this. I think it's today's management that needs to act in an intelligent way. And so we're putting quite a lot of effort on that. Of course, a lot of, it is ultimately I think the successor in 2050 is the one who's going to get to claim credit, but it's got to be, measurable year two, year one, whatever, right? I mean, that if you're going to put these in, I mean, you talk a bit about what Julius Baer is doing, travel, that kind of thing. What about like the next, that's like scope one, as they call it, right? What about clients? I mean, are you still working with, entrepreneurs or families that derive a large chunk of their wealth or continued earnings from carbon, coal, that kind of thing? Or what are you doing in that front? I mean, the challenge in these step 2 and stage 3 is really how to drive transformation, isn't it? And the easy recipe, I believe, is always to call for a defunding of carbon-intensive industries. Now, first, let's be very clear. Even if everyone sold the shares of coal mines, nothing would change in the first place with their business model. I mean, nothing would ever change into the future because they would not get the capital to actually transform any part of their business. They would just be in runoff mode for the next 30 to 50 years. That's probably, if you look at the large hydrocarbon companies and at some of the claims they're making of transformation, if they want to get there, they will need a lot of capital. And this is the big challenge, isn't it? How do you really fund that transition? How do you analyze those who are transiting and those who are not? How do you get to real data, end-to-end, data which today is not there? How do you then make those investment decisions? And that's why I think that the efforts have to happen at a much broader level. I'm having this discussion in our industry association, in the Swiss Bankers Association. We are having here in Switzerland the discussion, I think, in the entire nation with the authorities and with the politicians. And this is where the entire system will need to work together. Let's not, I don't think we should just be focusing at tiny little things which end up actually being counterproductive in the end.
Okay, let's certainly continue the discussion on the green economy, but let me first poll the audience once more, and this is about investor opportunities. You know, we spoke about some of the challenges. Let's look at the opportunities. So what are investors most excited about right now? So you have 4 options like before, just please choose one. It could be ESG linked securities, that's one option, cryptocurrency assets, private equity, or public equities. These are the options you can select from. I'd like you very much to choose, like you did just a few minutes ago with the other question, so to get a sense, you know, how the audience views these opportunities. Maybe a few more minutes.
Well, I'm interested to see what is coming out.
Yes, okay. So, well, private equity. Private equity is beating everything else hands down. Then we have ESG and crypto, more or less at the same level, and the old traditional stocks at the bottom place. So again, you know, I'd like to use this, you know, to ask you what you think about the opportunities for investors now. I mean, I guess the key question people have with all the uncertainties we discuss is, where do you put your money, right? So where do you put your money right now?
No. Now, where do you put your money? You put your money probably best in a barbell between, on the one side, very safe assets, and on the other side, a few growth opportunities. And the private equity majority, I think, is just the rational choice to do this, and has been the rational choice for so many years. I think private markets, and in that private equity, maybe a bit more still than private debt, which is more professional. But private equity has just played an enormous role in the overall mix of activities of our large clients. And many of this has happened first outside of the banking system. Let's be very clear. I think our clients have always had access to those direct investment opportunities, either in their industrial holdings or as investment opportunities out there in the market. And they didn't need banks. I think the banks have played a lot of catch up. We've been investing a lot on a fiduciary route, on a direct market route, and being able to show our clients a substantial number of very interesting private market opportunities.
But
I think we're getting better at it by the day.
Yeah, so I was interested in understanding whether you're stepping up the offer on these private assets, because yes, I agree with you, private equity has always been part of the suite of opportunities, but you know, if there is increasing demand, are you able to satisfy that demand as a wealth manager?
I mean, we are able to contribute that. I don't think we will ever be the sole source of it, and we should not be. I think that, that there's a vast established market out there, but we can play an important role either by access to deals through our purchasing power as Julius Baer for our largest clients, by access into the asset class in a more, let's say, risk-controlled way for smaller clients. I'm talking, for example, about vintage funds and the ability to diversify investments. I mean, let's be clear, not many clients can stomach individual large size investments in singular private markets opportunities. There needs to be diversification, obviously, given this risk profile. Then we have developed solutions, for example, around financing in this space. So cash flow-based finance on non-listed securities, which is, again, something important for our largest clients. Yes, we have been coming a long way, but this will not stop there. We'll continue to push. We'll continue to develop our suite of offering in this space. I think private equity will just become mainstream in the overall asset allocation of the larger and the largest clients.
Okay, let me ask you very briefly. I mean, I'm also mindful of some of the questions that are coming through, but I also wanted to ask about ESG and crypto assets. I mean, first of all, ESG, again, you know, our sense is that there is massive demand. can you satisfy that? But also, isn't there a massive risk of greenwashing? We've seen some issues, with some asset managers, DWS, I mean, just to mention one. So on the ESG front, how do you maneuver? And is there concern that, something which is labeled ESG may not be ESG?
ESG is not an asset class. I think ESG is just our environmental, social, and governance risks that need to be properly managed and addressed. And actually, this has happened for many, many years in different formats and different ways. And obviously, we need to find new ways to do it moving forward. But it's not an asset class per se. I think that there's an ESGization happening of all investments moving forward. And with metrics, we were just talking about metrics for transformation before. With proper metrics on today's carbon intensity of investments and on tomorrow's transformational value, the E dimension of ESG will just be managed in a completely different way. Let's see how the S and the G will be managed. By the way, there's a lot of pressure rising on S and even less metrics there right now, but this is just happening. And so I think if you look today at ESG labeled funds and non-ESG labeled funds, the fact that they're close to each other when it comes to an E performance is probably not that that people don't invest on those that are labeling. It's just that also those that are not labeled, that are catching up and are naturally coming to the same level. So this is just going to happen everywhere. Is there risk for mislabeling, for greenwashing? There's always this risk, of course. I do think that players and regulators are aware of that, and that there is a debate how to make things clear. What we need, again, it will be data, it will be taxonomies. There need to be clear definitions, but this is a tricky area to make very clear-cut definitions of what's truly sustainable and what not. But I think as more data, more definitions are available, it's going to get even clearer. I don't sense there's a lot of bad will in the industry. If I look at here, the Swiss industry associations, for example, the association of the association that I'm chairing, I sense there's very constructive development in this field. There's real energy put into this. Are we getting everything right? No, absolutely not. Are we in some areas at the beginning? But I think the direction is generally right. It would also not be helpful if all those discussions about green or not would be fought in the courts or be fought by politicians, ending up in completely different definitions in different parts of the world. If we go there, then the banks will again go on the back foot and actually play this defensively. I think this warrants a bit of offensive.
Okay, great. One final question I'd like to ask, and then we move to Q&A from the audience. Actually, this question is also coming from the audience. I'd like to have your opinion on crypto assets. I mean, can they become mainstream, and particularly in Switzerland, which is quite at the forefront of trying, to push for like a crypto exchange. I mean, I think crypto ETFs have just been approved. So what is your view on this type of assets?
I believe digital assets, in the broader sense of the term, will be transforming in the financial industry. They will have a transformative effect, and they will play a relevant role moving forward. Now, this said, Bitcoin at the most current end of things, or take either, are they going to stay? Yes, I think they're going to stay. They're so widely dispersed across the globe that with all the governments putting their efforts together trying to wipe it out, it would never be possible. That's just the very definition of a distributed ledger technology. Is Bitcoin on the other side the store of value that it once promised, or that the evangelists promise it to be? We shall see. I'm not quite sure whether Bitcoin can really play this role, given its idiosyncrasies in its value chain, in its trading, in its pricing mechanism, and so on. So we will see that. I'm actually more excited about the next-gen applications. What's happening if we now move away from proof of work into new ways of proving? I mean, staking is one of the keywords out there, and it's quite fascinating how much innovation is happening there. What will happen with tokenization of further assets? And I see a lot of attempts to tokenize real estate. Many of those attempts are still a little blockchain piece in the middle and very traditional value chains on both ends. But we might be seeing fully digital models in the next 5 to 10 years. Let's see where they carry us. We can talk about other assets, other asset classes that can be made accessible, like collector cars or wine. There's a lot of interesting things happening there. And then I think there's a whole raft of potential revolutions coming from DeFi, decentralized finance moving forward, where through the sheer force of programming on blockchains in smart languages, you can replicate entire parts of our industry that right now are just done in a very traditional way with a lot of manpower and a lot of fragmentation. And so I do think that as we will be moving into a world with instant settlement moving forward, as we'll be moving in a world that will be technologically enabled, banks and the financial services as a whole will have to rethink their value chain. And this is where I think the biggest revolution will come from. So we should not just watch this, we should actually be part of this evolution or revolution.
Can I ask you about Bitcoin or digital currency or all this stuff? I mean, here in Switzerland, I'm based here too. It's super pro crypto, right? I think it fuels a lot of those Lamborghinis you see driving around with the Zug plates on a Saturday morning. But I'm curious about, I think Swiss have a more embracive of the whole thing. What is your recommendation to clients around the world in terms of what they should hold in their portfolio? Like, how should they be playing digital currency in general?
I think Switzerland has always taken a general approach to consider the citizen to be responsible and capable of taking one's own decisions. And in that sense, I believe Switzerland is also constructive to new industries, to new ideas, to new things emerging, being very mindful of the need to regulate, and especially same function, same regulation. I hear this a lot also from our regulator, FINMA in Bern. But within this frame, I think it is great that Switzerland has preserved and is cultivating a degree of innovation and an ability to do and try new things. And so that's fine. Now, you've talked about a few Lamborghinis. Probably we won't talk about all those fortunes that have been lost. I think at the end of the day, you see a few winners, but then many people also will not have made much money with it. I think today, and that's coming a bit to where we are today with Bitcoin, with Ether, with all the kind of coins that are out there, it's still very, very hard to bring this within a highly regulated and advised space of a bank. I believe on an execution-only basis, if a client has a strong conviction that he wants to do this, we would obviously tell them how to do overall risk management, and that this should be a very small and a digestible part of their personal asset allocation. You can consider it still a bit of a lottery ticket. It might have evolved a bit from there, but it's obviously today not part of a fully advised asset allocation that you would get walking into a bank. How this will look like in 5 years' time, I think that's on another sheet of paper. But for that, I think this market, these assets will have to further mature, as will have the regulatory framework to make that possible.
All right. Let's see what else. Okay. What other questions have we got from the audience? Let's see.
There's a couple that maybe I can bundle in a single question. Several people are asking you, Philipp, where should wealth managers focus in terms of geographical allocation? And there are also questions, particularly with regards to India, where you are, one of these sort of one of the largest foreign players, really. So maybe I can bundle those two questions, together. So what's the next focus geographically, and what about India?
India is a very interesting proxy for that kind of question. I think we have a very strong market position today in India, which we've built over the years. We have a local presence in India as one of the few players, and we've been expanding on that presence step by step over time in a very risk-conscious way, with an offering that was always focused on a client, which is a bit tricky to defend in a market that is still very much product-led. And we obviously also have to be mindful of the regulatory framework, which in a country like India is maybe not as developed or is moving faster than in other places of the world. But I still do think that as a wealth manager, having and cultivating and developing growth options like India is something extremely important. This is a market with a lot of potential for the future. where the realization of that potential will by no means be a straight line. But I think it's right for us to be present in this market and to develop step by step. Otherwise, I think geographically, I always put it this way. I think we need to be properly diversified, and we talked about it before. We need to be present in some stable geographies that give us sort of a backbone and a steady income, a steady base for the business. And through this income, we can then finance some of the development activities in the emerging world, where we can tap into higher growth potential. But, and that's a big but, the number of those markets has to be focused, has to be limited. I think the time when wealth managers could cover the entire world is long gone. The time when a relationship manager could be sent into a new country to acquire the first few clients, to then see what to do with the market, they don't exist anymore. Today, we'd be hiring 2 compliance officers, a lawyer, we'd hire regulatory staff before we even walk across the border. And so the initial critical mass to start covering a new market is massively higher. And of course, from a portfolio perspective, I'd love to synergistically grow from where I am profitable already, rather than just starting a new market from scratch, which obviously has is going for a very, very long term in terms of economic profit. Still, there needs to be a good balance. And I think it depends on the size of each wealth manager, how many of those geographies it can cover. But the number is certainly not going to grow.
One of the other questions is, investments in currency and precious metals have been punished in favor of mainly tech and startup ventures. How is the Swiss marketplace positioned in this regard? That's a very specific Swiss question.
It's a difficult question. I think investment in the Swiss franc obviously is quasi a non-investment. I think it's nice to have them, but having them on your bank account doesn't yield much, frankly, in the best case, in the best possible case. Looking at volatilities in the currency space, I think there have been moments of attractiveness in the last few years, but currencies as a whole may have suffered a bit from very muted volatilities over a long period of time. On the other side, I think Swiss equities have proven to be a very strong store of value, almost a fortress in a global asset allocation. And I know many of our international clients would love to have always a core investment in Swiss equities. Again, one needs to be mindful of the idiosyncrasies of the market and of its depth. But at the end of the day, I think this is still something that for the time being should and will attract client attention.
Okay. Now, someone asked about, just going back to private equity, so I think it's a sort of reasonable question. Once you remove smooth returns, is private equity just leveraged listed equity? So in other words, like, could you just buy the Swiss exchange with the S&P with leverage and get the same return?
I'm not sure. I don't think so. Even though I'd like to ask that question to our specialists, and I'm sure they would have a much more elaborate answer. But I think looking at what underlying performance do you get, what exposure to what kind of business models, I believe that with private equity, you can get exposure to much earlier stage businesses in a much more concentrated way. Obviously, I mean, some of the large players have more diversified portfolio with early stage and with later stage technologies, for example. But I'm not sure if the two things are just interchangeable. But I think the private and the listed market together just make the totality of equities. That's a bit how I tend to look at it. And by the way, the size of the listed market is also not something constant. It has actually been shrinking over the last decades. And a lot of wealth has been created on the private side, where companies also started to list much later, 20, 30 years ago. This was done much earlier. So I think that I just look at this as a total pool, and then in this pool, different things can happen.
Yes. Okay, I think we've run through some of the Q&As. I mean, we've bundled a few also in the questions we've asked earlier, Philip. And, as we get to the end of our conversation, I wanted to ask you a couple of questions about Switzerland, the attractiveness of Switzerland as a marketplace, as a place for investment. I'm sorry to say that every time there is one of these big data dumps, like you've seen the Pandora papers today. I mean, Switzerland comes up again, or at least, there are elements of Switzerland coming out, linking it to offshore trusts and, shell companies, or at least, people advising, other rich people to create these structures. So, is this still an issue? Because there was a feeling that with the abandonment, with the sort of removal of bank secrecy, Switzerland had moved on, and somehow those issues were a thing of the past.
I would say Switzerland has come a very long way in the last few years, and probably Switzerland, and I can now talk only from a bank perspective, which is not related to the new papers that have been published. I think from a banking perspective, the Swiss banking place is no place to hide. Let me put this very clearly, and I think clients have absolutely understood that. I think Switzerland is still one of the dominating financial places in the world. And just from a first glance and from first listening to what financial places are now getting quoted again, I think it's again all the financial centers across the globe. And so there's a natural affiliation also of Switzerland with things like that. Again, I'm very confident that, and I can talk here for my sector, that in the banking sector, the homework definitely has been done. And in that sense, we have a strong base for the future. Will we always be, to some extent, also under attack? Yes, of course. Under attack on the one side from attempts of abuse, that's clear. On the other side, under attack also from those who think that the Swiss financial place might be too strong and who would like to develop their own financial place. That's just global competitive dynamics that then sometimes are continued through the means of politics and regulation. But I'm confident that the way that Switzerland is on is the right way. But again, we need to take all of these things extremely seriously and look into them in a comprehensive manner. For that, we need now, obviously, a bit of time to see what has been discovered here.
Absolutely. But again, on the general issue of competitiveness, for instance, is Brexit a challenge? Is it undermining somehow now that the UK is outside the EU and obviously are a large financial center? I mean, isn't that, quite a big threat for Switzerland as a financial center?
No, I don't think so. I think Switzerland had always to take its competitive position in the globe. Switzerland was always punching above its weight, and Switzerland had always to defend itself against global competition. And it's no exception that, for example, Swiss banks, and I count myself in wealth management among them, Julius Baer is among the top 5 players in the Asian wealth management market, which is one of the most competitive markets in the world. And so through our services, through what we can do, I think we have a very high degree of attractiveness out there, and we know how to develop this business, and clients do trust us. And I think this is going to be true also in the future. Yes, the competitive dynamics are changing, and some countries might be at a country level, at a nation level, trying to do business development for their financial industry. Sometimes these are also opportunities to collaborate and to work together. And I think we have a good understanding as Switzerland with Great Britain at this stage. But let this be a competitive world. And I do not shy away from future competition.
Okay, thank you, Philip. I mean, I guess on this note, we are going to end this conversation. It's been a lovely one with lots of topics we've touched on. Thank you so much for joining us today at this Reuters Wealth Newsmaker, and we hope to have another opportunity to discuss this and other topics in the future.
Thank you, Lisa.
Thank you, Philip. Thank you. Well done, Lisa. Bye, everybody.
Thank you. Bye-bye.
Bye-bye.